why don't we solve this more structurally than just writing our small little dinky checks here and there? So in 2020, 2021, we turned to some of our industry friends, Kirsten Green at Forerunner, Charles Hudson at Precursor, Kanye Akabel at Kindred, a bunch of people, 10 folks in total, eight plus us two, a bunch of people who had all over the last like 5 to 15 years created their own firms and said, we all know from our own history that emerging managers can really outperform. We all see emerging managers in the market today who show up, on cap tables with us or who we've backed that are amazing. And but the way that we're doing it today, we can only solve as one-offs. What if we created something that had a bigger structure? And so that could do two things. One, it could write checks for 10% of their fund. Screendoor tries to help anchor a fund by, if it's a $20 million fund, writing a $2 million check. If it's a $100 million fund, writing a $10 million check. So we're a big sum of capital. And two, creating a little bit of community and ongoing relationship between the managers we've backed, as well as the folks like myself, the sort of advisors, mentors.
Welcome to Sorcery. I'm Molly O'Shea, founder of Sorcery, a weekly top VC deals newsletter highlighting the top GPs, founders, and deal announcements leading the next innovation cycle. Today, we have Hunter Walk, partner of early stage fund Homebrew, which now operates as a self-funded structure, meaning they do not take outside capital from LPs. And he is also founder of the fund-to-fund Screendoor, which focuses on emerging managers. Hunter is one of the internet's most beloved tech figures, with over 800K followers on LinkedIn and over 266K on X. This is extremely insightful conversation on both funds, fund structures, founders, and fundraising. I hope you enjoy. Hi, Hunter. Welcome to the pod. Thanks for joining us.
Thanks for having me. I'm excited. I see, who you've had on previously via your weekly newsletter, and I was getting intimidated.
Yeah. Well, I don't think you should be intimidated. I think if anything, you're probably one of the biggest legends who will have come on the podcast so far. So I'm very, very happy and grateful that you're on it. And I'd love to get straight into the evolution of Hunter Walk. Okay, so here we go. Let's start at like the most recent kind of evolution and where you are now. So a couple years ago at Homebrew, you set out to do something pretty much contrarian to what the market was doing with venture funds.
Mm-hmm.
A lot of funds were just racking up more and more dollars, increasing their fund sizes, aggregating management fees. And not only that, but just there was more access to capital in the market. So there's more funds, there's larger funds. I'd say VC just entirely started to look different, and it's acting different, and there are just different incentives there. However, you and your partner Satya at Homebrew did something completely contrarian, and you decided to pull back and start deploying as a self-funded fund. So could you just walk me through that and talk more about the incentives there and why you decided to not take outside capital?
Yeah, absolutely. I mean, so Homebrew itself was founded sort of late 2012, early 2013. And it was an outcome of my friend and former colleague, Satya Patel, and I always wanting to work together again. And he had been running product at Twitter, left there. I had been running product at YouTube, was sort of preparing to make my exit out of Google for a while. And having that blank sheet of paper moment to work together led us to a conversation about, well, what would we do, right? And neither one of us had ever talked about, we should go raise a fund. So I think part of understanding why we made the decision we did in 2022 really sort of talks about that sort of how we started, which we started with the idea of, well, how can we spend the rest of our careers working together, working at the early stages of companies, which whether it was org chart or cap table was always where we had the most fun. And how can we keep things as simple as possible so that, we can maximize the time together and the time with these founders and not everything else that goes into, sort of large teams or lots of networking or whatever. Just I just want to work with great founders. And so that led us to say, well, there's a business model for that. It's called venture capital. Let's start a venture capital firm. It happened to be at a time where the second wave of sort of seed firms were getting created, the people following in the footsteps of the first rounds and lower cases and uncorks. And so we hit the market at a time that I think a few things made sense. First, sort of like the pairing together of capital and counsel, right? Could you write a big check to help put these companies in business and deliver, something that helps them increase the probability and velocity of success? I don't think you ever want to invest in people who like need your help to succeed, but you hope to back people who have a high probability of being successful and then sort of, tilt the scales in their favor. So, we started a firm that co-led seed rounds in a dedicated fashion. And I think, seed was still seen as something different, like this period to learn, not just period to fundraise and, build a growth curve, rush to the next round. And we're like, we love that. And so we spent about a decade in exactly that model. 3 institutional funds, lead or co-lead, rounds. And it was great. Really enjoyed it. Obviously, we spend an incredible amount of our time still working with those companies, as companies as early as Cruise and Plaid and Chime, and, as recent as a kids pediatric company called Clarity. So like we have things at every stage. But unlike a lot of our peers, we started to see the change in the industry, as you pointed out, like the business model was getting in the way of the work in some ways, right? Like the idea that you grow your fund size to the point of, supply, or I guess, demand, like how much can you raise? And then you think about all the other things associated with that. Well, now I need a different team. Now I need more partners. Now I need to own more of these companies. Now I need 10 outliers per fund as opposed to 3. Like all of those are implications that I think actually when venture firms don't consider and they just raise more money and then figure it out as they go, like are bad for LPs and bad for founders and thus bad for those firms. And so we just decided that we loved what we were doing, but that the business model shouldn't get in the way of it. It's almost like if you think of like a marketing conversion funnel where, at the bottom of it, you fall in love with an entrepreneur, and then at the bottom of it, you have to say, and you have 10 to 15% of your company to sell me at this price range. Like, obviously, even though we were really excited about all the people we worked with, like we wanted to remove that. We wanted to remove that last piece of friction, and just be able to say, oh, we want to work together. Great. Are you fundraising? We'll write a check, we'll be the first check, we'll be the last check, whatever. And so that's basically why we did it. We didn't want to get bigger for all the reasons you mentioned, and we can talk more about, how I think that incentive structure is hurting venture capital and hurting startups and hurting LPs. But it was an easy decision for us to make. We are sort of owners of a small business to that extent. And the idea of, look, let's put our own skin in the game. Maybe we're not as risk-seeking as, the CEOs building companies, but we're certainly more risk-seeking than the average VC, I guess. And so we said, we're going to keep our team together. We're going to keep our firm together. We're going to make the same number of investments each year, 10 to 12. But instead of having an ownership target that forces a certain check size, so on and so forth, we're going to write most checks between 100K and 500K at seed, and then we'll do some larger or later. And we have access to capital outside of our bank accounts, so to speak, when we want to deploy it. And we can talk about some examples of when that comes into play. But we want it to be 100% skin in the game. And that's what Homebrew 4 is. It shows up at cap tables as Homebrew 4. I sort of joke it's Homebrew forever because it's meant to be kind of our evergreen vehicle. But that's why we made the change. There's plenty of interesting reasons outside of just greed, why to grow a venture firm. But I think for us, it was most important to say, what gives us where's the intersection of success and happiness? And for us, that's being able to optimize for the companies we want to work with and the co-investors we want to work with, and doing that at scale.
Yeah, and it's a very thoughtful approach. I don't know, and I'm sure I'd love to get into this further when we start to talk about Screendoor, but coming into VC and the asset class in general, it's a very ambitious, very exciting world. Like there's lots of great upside potential. And so when some people start out and they start to raise funds, the goal is to increase fund size over time. And then those incentives kind of come along with it. But then that also drives a lot of maybe externalities that some might not be aware of. But it seems like you and Satya are very aware of those externalities and what
even though even though Satya did, Satya and I both came from product backgrounds. He did venture as well. But I think like when you come from a product background, you sort of think about things in structures and frameworks and what are the most important things to optimize for. And we always just wanted to focus on, sort of the question of what can we do uniquely for founders? Let's assume that in some cases we're going to be investing in people that are non-consensus, right? Like, our support of them helps kick off or catalyze a fundraise that otherwise might not occur. But very often, we're going to be talking with companies that, especially at the seed round, have a surplus of demand, more capital that wants to invest in them than might be able to. And so, the investment manager sales part of this game also sort of forces you to ask, well, what unique, places in this mosaic, can we inhabit, right? And I think we inhabited, if not a unique, at least a privileged place for that first decade. And now we've maybe created a place of, a different privileged place, which is like the flexibility and alignment of an angel with kind of the gravitas and experience of an institutional, and frankly, for a lot of reasons, like you said, that's unique because the people who usually try to skate to that either failed at being VCs, so they're not very good at their job and they're, sort of retrenching, or they were so good that they essentially wealth effect retired and are just making a few angel investments here and there, but it's not their, they didn't keep their firm together. It's not their 365 a day job. For a variety of reasons, we decided to inhabit that weird space. So far, it's been great. We've made 28 investments or so. I think we're just closing on a 29th. 100%, 100% win rate, for whatever that's worth type of thing. But more importantly, I think we're able to, work with some of our favorite investors who before maybe we were co-opetition with, or we'd only be able to work with when, we did the seed, they did the A. Now we can just all combine to help these companies. And, from an early perspective, it's very much, we don't need markups to raise our next fund. We don't need to get on any, top 40 lists or this or that. And so when we're working with a founder, like there is no gap between their incentives and ours. The outcome, the speed at which it happens, and hopefully that makes us a really good partner to them and provides a set of insights, perspectives that's different than, what a pure angel investor would give them or what, a traditional large VC would give them. The best cap tables over time include all of those, right? I'm not saying, oh, I've solved some, incentive or alignment problem for venture, so on and so forth. I'm just saying that, like, as you were pointing out, there's structural reasons why people like me don't usually do what we decided to do. It just so happened that most of those were either neutral or negative for us. And so why encumber yourself with that, right? We didn't inherit a fund. We're not the second generation of partners trying to hand it down to a third generation. We're not trying to train the next generation of investors in our image. We are trying to leave our industry better than it was when we started. And we talked about how Screendoor is actually the mechanism for that. There's some investors who also like to feel that they can go $50 to $100 million deep into a company, even if they're the only one who believes, right? And you need a large AUM to do that. I totally respect that. That's awesome in the ecosystem. And then, as you said, there's a ton of financial reasons and ego reasons to do it, which, maybe I'm just late enough in my career that, I'm willing to take some trade-off there.
Yeah, I mean, a lot of it comes down to, like you mentioned, like GP fund strategy fit, what you've learned in your career and experience, what you've observed, either getting funded by funds or working closely with them, and then packaging that up together. I mean, in the grand scheme of like the asset class in general, all of these different players are always going to exist. That diversification is what makes VC like very robust. And it comes in waves. Sometimes some do better than others. Sometimes, the opposite happens. And I'm curious, actually, I'd love to like go in a little bit deeper into the structure itself. So some people might think, you have a self-funded fund, you two are billionaires, you're writing like $2 to $5 million checks. You're doing 29 of them. Maybe you are. I don't know. But could you like go
Yeah,
maybe a step further into how you structure the
sure.
fund and how traditional funds are structured? What the difference is between the
Yeah,
two?
when we talk with our peers, like when we announced this a few years ago, the three biggest myths or three biggest responses that were wrong were one, well, I hope you enjoy retirement, which is like, no, in fact, like I probably, I'm going to work even harder now that I've got this plus our existing book of business plus this fund of funds we're building called Screendoor. Second was, must be nice to be a billionaire. I'm like, I only want, I like, no, like obviously I'm fortunate, but like I own one house, and it's the house I've lived in since 2005. It turns out that if you live below your means and are willing to go into your savings and the opportunity cost of giving up millions and millions of dollars of fees, that like a lot of the people who were saying that, um, I believe, had reached economic levels beyond mine, but it's really sort of like, why are you doing this and what risks are you willing to take? And then the third was, must be so nice to not deal with LPs. I'm like, we love our LPs. We've always had a small group of institutional LPs who've been a joy to work with and we continue to work with. So it was much more about sort of optimizing for the type of investing we wanted to do rather than sort of any other reason. You sort of said, well, talk to folks about how a traditional fund is structured and how this. So a traditional fund would have um, you know an increasingly large team, most of which are cost centers. They're salaried employees being paid cash and a bonus to do their job. Then there's a very small group of people that are sort of like general partners, managing partners, who are essentially the owners of the fund. And they split up the economics of that fund equally or less equally, depending upon their own culture and dynamics. And so to use a bunch of like standard round numbers, you might have $100 million fund that operates at, let's say, quote, 2 and 20. It means that every year they essentially take 2% of that $100 million for fees, $2 million, and use it to pay salaries, legal expenses, rent, branded chinchilla vests, all the weird stuff that VCs like to do. And then once they make more than $100 million, so like those $2 million are really loans, essentially, you can think about it some way. If you suck at investing, if you can't pay back that 100 million, then it's your salary. But you essentially have to return $100 million, worth of venture outcomes, and then you keep 20% of any incremental dollar. So if I'm a venture fund that was raised $100 million and I end up being worth $200 million, I doubled the money. The first 100 million goes back to the LPs, and then the venture fund would keep 20 million of the incremental 100 million, of which some of it might be used to pay additional bonuses, so on and so forth. But you can essentially think of that as being divided between the partners, the carry structure. And that's the way, numbers being a little bit different, but that's generally the way we were organized prior. I'd say with maybe one specific asterisk, which is we've always given anybody who works for Homebrew carry in the fund. So our head of ops, executive assistant, our head of talent, in addition to getting salaries and bonuses, they get unbounded upside in our success. And it's difficult to administrate. It's like another thing to do. And of course, like maybe they get quote unquote overpaid if we're a very successful firm. At least that's why people tell us that they don't do it, but we do it for exactly those reasons. I think there's a lot of times that VCs will give advice to founders and then not take it themselves. And so imagine a VC going to a founder and saying, well, stock equity is so important. That's why everybody feels they're rowing in the same direction. They have upside, so on and so forth. And you're like, oh, great. Do you give the equivalent of ownership in your business to everyone who works there? And you're like, well, no, that wouldn't be appropriate. Here's all the reasons why. It's kind of bullshit. And so we've always given essentially sort of upside in the fund to anybody working on the fund. But otherwise, very traditional. What we did for Fund 4 was one little change in some ways. Instead of some wonderful LPs, endowments, foundations who we'd raised money from in the past, we held them aside for the moment, and we just made Satya and myself the LPs. So when we do a capital call, let's say that $100 million, and you say, oh, we need $5 million, to write a check, as opposed to sending that notice out to the administrative office of, one of our endowments or something like that, that shows up in my inbox. And so, I wire money, to Homebrew so that then Homebrew can wire it to a portfolio company. we changed two things about the fund structure as well to make it more manageable for us. The first is I used a plug number of $100 million there. We don't have a fund size. So basically we have a budget in our minds. Sasha and I figured out like how much of our own personal capital we're willing to sort of put to risk each year. And then kind of like in our mind pre-funded that for 3 to 4 years in the sense of like, okay, we're at least going to, invest this much in startups over the next few years. So that's a little bit different. And then the second is there's no fund life. So often your investors want their money back in some time period, 10 years, 12 years. And, sometimes you can get extensions beyond that. This has actually, it's not quite evergreen. It has a very, very long fund life since we use the same. So you can essentially imagine that like we are the investors in ourselves for as long as we want to be. Other than that, you can imagine we're not collecting fees. Like that would be weird. We are paying our team. So, obviously, the salary has to come from somewhere. But otherwise it's just that. And so, then what's the upside? Well, we're taking 100% of the risk. We keep 100% of the outcome, right? So as opposed to that 20% carry, we have 100% carry because we're 100% the LPs. The whole is not greater than the sum of its parts, right? Like you have to actually, if you run the math on the difference between like doing it this way versus saying, and raising another $500 million in venture funds, like we are not doing this because we think it's the absolute best economic outcome. We're doing this because we think it's a good economic risk to take to do the work that we love to do. And that's basically the structure. I mean, there's like some tweaks here and there, but it's pretty simple. It's like not as complex as somebody would imagine, and that's sort of how we've operated. We considered it an experiment, now we sort of consider it the new normal. But we have different sort of ways to pull other capital in alongside or subsequent to ours when the check we want to write or that a company needs is sort of bigger than our bank account. But we don't have a portfolio model that says, oh, the strategy is Hunter and Satya put in a little bit of their own and then then triples down with $30 million in the growth round, and that's how we figure it out. And all, like when we write a check into a company as Homebrew 4, we hope to have the opportunity to continue support or put more capital in if it makes sense. But we write that check assuming it'll be the only check we write and that the juice is still worth the squeeze, right? So that's it. Like it's just very simple. It seems to really resonate with founders. They understand, as you said, like I think founders, as there's more and more venture information out there, I think founders obviously, have investors they love working with, have investors that they've had, more mixed experiences with, but just the idea that the incentives are aligned in a way that is more difficult when somebody is representing a pool of capital and that's not their own, and a career trajectory that has its own sort of goals. So it's great. Like we get to be a true partner to the entrepreneur, and that's ultimately what we're care most about.
I think that the venture world is kind of like stuck in this chasm of continuously building and creating larger and larger funds, and we've started to see in the last few years those incentive systems like really. I
mean, Molly, 100%, right? Everybody is participating to some extent in their own self-commoditization, getting bigger and bigger because you play the game on the field. So if the other funds get bigger, you have to get bigger. In addition to it, being quite economically beneficial for the firm itself. They all look and feel the same. There's your strategy. Your fund size is your strategy. So you have to sort of find the outliers. There's only so many quote unquote outliers that exist. So you're all fighting for them in ways that are make it more difficult to be contrarian. And Darwin, for a lot of reasons, moves at like half speed in venture. If Darwin moved faster, great. Then a bunch of these mediocre large funds would go out of business quicker. But there's a host of incentive and human bias reasons why Darwin moves slower. And so it takes, a decade or more, barring a real a partnership breakup or, something illegal, right? Like it takes a decade or more for a underperforming fund to actually exit the market. Well, meanwhile, those hundreds of millions of dollars backing that firm could have been better deployed into competitive emerging managers who have new ideas, new perspectives, new networks, and can return actual alpha to LPs. So, I am, I hope that I'm a competitive species within that, that Darwin ecosystem I just talked about. And Screendoor, which, I know we'll get to, is about releasing, helping to release a number of new kind of, alpha evolved species into this, tidal pool of venture in order to try to speed Darwin.
Yeah, and I think like the most important takeaway from at least studying your fund model and the incentive system there is like not you guys talk the talk and you walk the walk and like you actually deliver on your firm values, whereas as we know, like most of them are espoused and not enacted within these funds.
Oh
And I'm
my,
not like trying to talk too negatively about the
no,
asset
no,
class in general because like it has evolved this way because of these reasons, and it's unfortunate, but like the domino effects do go right down to the founder.
yeah.
I've had
Look, I'm a capitalist, right? Like I'm not, what's the expression? The
yeah,
master's tools won't take down the master's house. Like I am the master's tools, right? Like I'm not trying to burn it down. I have two perspectives. I have a belief that the status quo is not the game I want to play, and I believe that the status quo is not uh, uh, outcome maximizing for the ecosystem itself. And so I try to pushing on both of those, figure out where I am in this world, and then help the industry move forward a little bit. But like, I think venture capital is great. It's a toolbox though, and that tool should be useful to entrepreneurs so long as it's valuable to them. I don't think, I think, venture supports great companies. It doesn't create great. And also, like it's important. Like, I don't think, look, Satya and I picked a very particular strategy for ourselves. That strategy is more or less, I think it's going to work great for us. It's more or less appealing to other people, and it's certainly not anything I'm trying to portray as the future of venture. I'm not like, there was venture 1.0, venture 2.0, and now look at me, I'm venture 3.0. But what I do hope I can prove or provide some, case law on is that you don't have to, you can run your own playbook. That there's lots of different ways. So long as, like you said it perfectly, so long as you like know who you are, can deliver against that, and the incentives make sense for all participating parties, like you can do what you want. And I think sometimes it's easier to follow the path of least resistance, but then that's like sometimes you like to sort of break away a little bit and say, well, there's another way to think about this. So that's all we are, or another way of thinking about it. I got the Homebrew tattoo on my shoulder when we raised the fund, not when we returned the fund, because I wanted to say, like, regardless of outcome, like this was a good idea, and so that we commit that way. Yeah, I've only had to like roll up my sleeve once or twice to win a deal, but it's at the ready.
We are committed. We are stamped with permanence.
Exactly. I'm like, hey, you're asking me if I'm committed? Look at this. Yeah, but I used to think. I've been around for a while. I moved out here in the late '90s, went to grad school, and then had an operating career for a bit. And so I was familiar with venture. And I think I think before participating in the industry, what I would have thought was that like, oh, take all the practitioners, and it's a double hump, that there's like 40% of VCs who are like absolute kingmakers. Say that, like, if you get them on your board, you've just, de-risked, failure and increased success by orders of magnitude, and they're incredibly smart. They know everything. They can pull every string. And then there's 40% that are like the worst people in the world. They're trying to take over your company. They'll fire the CEO the first time they can, and they're, essentially like, vulture capitalists, right? And then you get inside the industry and you realize, like, actually, it's a single hump. There's 5% of VCs who are really, really good at what they do. And even part of that is self-awareness, right? Oh, I'm best in these situations and this stage of company and this type of founder. And so I gravitate towards that. And then 5% who are really horrible. And even that sometimes is situational. Like, the firm dynamics are causing a lot of stress, and that somebody doesn't react well to that stress, or so on and so forth. but I keep a list on that 5%. We don't work with them. And then everybody else is just this like 90% trying to do the best job possible, and hopefully be the best version of themselves while doing so. And so, like my goal, over the lifetime of Homebrew is like occasionally I have some founders who would put me in that 5%, of the good side, and then, live in that 6th to 10%, right? Of, I always, did more for you than you thought I could do, and I guess that's sort of like our NPS, and we think sort of like DPI and IRR sort of like follow that. And fortunately, I can say that for at least 2.5 years, 2013 to the middle of 2015, like we were very good at our job. Like even if that fund didn't return another dollar, we'd be like a top 1% fund, and fortunately, it's going to return more dollars. But everything else after that, I have good indications. Like I have founders who are proud to be associated with us, and we're proud to be associated with them. But like, we're gonna have to wait a good number of years, still until I tell you like, oh, I was good at my job for a decade by, all definitions of what it means to be a good investor.
Yeah, and look, like Hunter, you're in a very fortunate position because you have had outlier investments. And I want to give you the opportunity to brag a little bit. Like, I know that's a little bit off-putting for some of the VC world, but that's what we're here to do. Sometimes, not all the time. But could you just walk through some of your largest investments or outcomes and what you might have learned from them and what you're focused on investing in the next, 3 to 5 years?
Yeah. So we're fortunate enough that, of our first, 20 to 30 investments, let's say. So our first like 3 to 4 years included meaningful investments in companies like Chime, the fintech ecosystem that we were kind of early to and co-led their seed round. Plaid, of course, also in the fintech ecosystem. Gusto, Cruise, autonomous driving, which exited. We led the seed round for a company called Shield. It's one of the larger, now I guess what I call, defense tech or, autonomous pilot. There's different venture firms that have branded that sector different ways. I won't use their nomenclature. I'm not, but I always say like your thesis is your portfolio page. It's not your tweets. It's not your blog post. It's not your market maps. The saddest thing in the world is to be an investor who like gets all of those right, but then doesn't invest in the best companies. Like, then you're an analyst. You might as well be a research analyst. You're not an investor. And so we've been fortunate enough to be early, I guess, and correct in some ways. And then we also, I think, now that people realize that its valuations and exit outcomes have sort of reset to historic multiples, that like, of course, it's a power law. But when the power law sort of says $1 billion and $5 billion exits are the norm, not 50, I think more investors are realizing the importance of concentration. And so some of those names, not all of those, but some of those names that I mentioned, we started out owning 8, 10, 15%. So you can imagine that even if we didn't follow on in every round, that as a company grows from a $10 million, $12 million, $15 million seed investment that we own 10% of to a $1 billion, $5 billion, $10 billion company, you can do the math. And the fact that, for example, our first fund was a $35 million fund, which included all of those names, you can sort of figure that. And that in some cases, I think I've talked about this with Chime, we took some money off the table along the way, like not because we had anything but belief in the company, but because, you're always a buyer or a seller, and you sort of need to figure out, as a $35 million fund with a $25 billion financing, maybe you should de-risk the position a little bit. And so, we were successful investors and successful money managers. More recently, I think, you hope that like, you use your you come out with a thesis and some momentum. You hope that converts to good investments, and then that sort of builds the brand and becomes, the sort of reinforcing factor that allows you to see great companies, and be considered amongst the people they want to work with, right? So that was a good start for us. We were excited by that, and it continues today.
That was a fabulous start.
Yeah, well,
That's an amazing start.
I think the people, I'm just, I'm glad, vintage is always such a determining factor in outcomes, right? And so we were very lucky to get started at the time we did for a variety of reasons. But, I think we also did a good job of, um, you know, uh, knowing when to write that second check, knowing when to take a little bit of money off the table. We had some early exits that allowed us, really on recycling. Like our first two funds, I think, are all maybe are 100 north of 120% recycling. So we really double, triple down. Recycling is people, I was using the example before of you draw down fees, right? But you have to invest the whole amount. Recycling is when you've already invested, all the capital you've called, you get some money back, either because there was an acquisition, a wind down, whatever. And instead of distributing back to investors, you're like, I'm going to let it ride. I'm going to write another, I'm going to keep investing. And so if Homebrew One, was a $35 million fund, 120% invested means we've actually invested $42 million. Like, well, how do you do that? It's only a $35 million fund. Well, you invest some dollars twice, right? Like, and that just gives you more and more leverage. And so it helps returns. So
I
like,
would love to
even though I'm a product guy,
yeah.
I'm a product guy, and I sort of sometimes joke, I'm like, I'm an alpha who comes off at beta. I'm like, I know how to manage a spreadsheet, and I know how to make money.
That's hilarious. Oh my gosh.
Don't
Yeah, no,
don't
I
have
would love to
don't have to
actually
be on the
unpack.
Midas list.
You don't, you might be pretty soon. So I wouldn't say that
No,
too.
we'll never be. So the two reasons we never were before were you have to submit information, which we don't like doing. We think that's not to the benefit of our portfolio. And two, you have to do deal attribution, right? So you have to say, this is someone's deal, this is Satya's deal versus Hunter's deal.
Mm-hmm.
We've always made decisions by consensus. And even though when we took board seats, one of us had to take the board seat, but we've always made decisions by consensus. And, we've never wanted to do that. So that disqualified us. It was a non-goal anyway. Or like, I don't care about that stuff. So anyone who's on the Midas list, no matter what their firm says, they've turned over, information to a third party about their portfolio, and they've decided internally that somebody gets to claim credit for that deal, whether it's the person who deserves it or not. And now actually we're not eligible because you have to also have external LPs. This is a funny story. So for some reason, I forget exactly what it was, but maybe there was some like list. I think Satya's dad actually pinged them and was like, how come Homebrew's not on this? And they responded back, they're like, well, they're not eligible anymore because they don't have outside capital. And I was like, that's great. We got the parents going to bat.
That's amazing. I mean, well, yes, you are, and you have built an amazing firm, and you guys have great access, and you have made those investments. So that's all validated. And like, in terms of, let's say, starting out Homebrew, operating in VC for a while, seeing these power laws, seeing the incentive systems, this now brings you to Screendoor, your fund of funds, where you're backing emerging managers. You've also experienced and seen the massive upside of the potential of like the first and second fund positions, as well as, having smaller funds. So I'd love to just understand more on like, how did you get to develop Screendoor? What's the antithesis of like your meaning, your outlook, and what you're trying to build there?
Yeah. So at its most basic, as you mentioned, Screendoor is a fund of funds. What does that mean? It means it's a fund and a team of people who, as opposed to investing in startups, invest in other VCs, right? And what they're trying to do is, based upon their own strategies, pick a great group of VCs that they can invest in on behalf of their investors, who might not want to go direct, might not want to build out might not have access, might not be as skilled in sort of understanding, who are the best managers and why. But as you can imagine, there are lots and lots of groups that want exposure to venture, can't buy it in the stock market. If you, by that time, it's too late if those companies have gone public. And so how do you invest, in venture? Some of them do it directly, right? Like, I write a check to, a Homebrew. And some of them do it through groups that pool that capital and then deploy it into a number of firms. In addition to hopefully those people having good picking and access, it also, if you're an investor in that, it makes sure that you're spreading it against enough managers to sort of lower the risk of, failure, right? So why did we start one? Well, first I should note that today it has a team of 3 that is not me and Satya. We're obviously still quite involved, but Lisa Cawley is the managing director, and she hired two amazing team members earlier this year. All three of them come from the LP side of the house, and it's fantastic. I love working for them. But we started it because I guess the intersection of two things. One, what we knew Homebrew wasn't going to be, and two, what we saw the venture industry failing to become. So what we knew Homebrew wasn't going to be was a multi-generational, multi-partner firm. That was, like I said, a non-goal. But you always have the desire to sort of provide some help, some mentorship. Find people who are doing what you're doing and collaborate with them, help them reach their goals. I learned, you pass your learnings on, and you also learn from those people. And so, we started doing that, I guess, by writing, smaller personal checks into what you'd call like emerging managers, people raising their first or second funds. As we got a little bit of liquidity, that was like my equivalent of angel investments, right? Like I couldn't invest in companies directly anymore. I had to do that through Homebrew, but we could make angel investments in other funds. And that turned out to be really rewarding. I got to see people coming up with their own strategies, their own reason for existing, their own conviction. I saw that very often the most interesting and best performers of those were folks whose lived experiences, identities, or networks were differentiated, weren't just folks who are going to be fast following anything that the big firms did and, figure out which billionaire they wanted to kiss the ass of on social media to get, a few crumbs of allocation, in the deals that person led. But people who anywhere from earlier to contrarian in what they believed to be true and had a unique skill set also to offer those founders that they backed as a result, that they work hard to win a deal, but work even harder to service the deal. And I was like, wow, this is great. These people are freaking awesome. Some of them are probably going to be better than me, right? But yet, so often they spend much longer fundraising than we did because they don't necessarily have the connections to the industry, or they don't look like a VC looks like, the average VC looks like. They, by choosing to go at their own, as opposed to get layered within a firm, they don't necessarily have the structural mentorship to ask questions about like, is this normal, right? We didn't necessarily have that, but we had two things. One, Satya had done this before, and two, we knew a lot of VCs we could call, right? So it was fun to sort of invest in these people and help them, but see that like actually firm building is a adjacent skill to startup investing. And these people were trying to do both. We said, okay, well, why don't we solve this more structurally than just writing our small little dinky checks here and there? So in 2020, 2021, we turned to some of our industry friends, Kirsten Green at Forerunner, Charles Hudson at Precursor, Kanye Rakabel at Kindred, a bunch of people, 10 folks in total, eight plus us two, a bunch of people who had all over the last like 5 to 15 years created their own firms and said, we all know from our own history that emerging managers can really outperform. We all see emerging managers in the market today who show up, on cap tables with us or who we've backed that are amazing. And, but the way that we're doing it today, we can only solve as one-offs. What if we created something that had a bigger structure? And so that could do two things. One, it could write checks for 10% of their fund. Screendoor tries to help anchor a fund by, if it's a $20 million fund, writing a $2 million check. If it's a $100 million fund, writing a $10 million check. So we're a big sum of capital. And two, creating a little bit of community and ongoing relationship between the managers we've backed, as well as the folks like myself, the sort of advisors, mentors, whatever type of stuff. And so we took that to market, and we took it to our LPs, the endowments, foundations, other folks. And we said, hey, look, we're going to solve a problem for you. The two problems that I know you have are you're putting billions of dollars to work, so you don't always have the time to like research every small new fund. And the checks that you need to write need to be big enough to make a difference, right? So like you writing $2 million check into one fund one, doesn't make sense, for you. But you want to capture that upside, and you want to build relationships. By their second fund, their third fund, your fourth fund, you might want to write a $20 million check into their, larger fund. They said, yes, that makes sense. We like that. So we raised a first fund, hired a team, and have been deploying that. We have 16, I think, managers now that we've done. And so that's sort of what a fund of funds is, right? It takes money from, in our case, other sort of institutional LPs, deploys that in meaningful chunks to VCs who are building new firms, sort of their fund ones, fund twos, provides them, not just that initial check and then, demands quarterly reporting, but tries to provide, coaching, mentorship. We're an LP that's been built by GPs, right? So we're a little bit different than the average kind of, I'm a banker, I'm a financer, that type of thing. We think of them as the customer as opposed to us being the customer, right? And hopefully that kicks ass. Now, I said, that's why we did it. Why does the industry need it? Well, the industry needs it for two reasons. One we talked a little bit about before. I think everybody's funds have gotten so large, so monolithic, so consensus driven, that there's a real white space for folks who have differentiated strategies with fund sizes that match those strategies. I think it's a great time to be a differentiated, quote unquote, new manager, right? They are going to eat the lunch of mediocre firms, slow moving firms. The other thing is, I think, these large firms, venture moves quickly out of fear or greed. Everything else is slow, right?
Yeah.
So greed, SPACs, crypto, AI, all of a sudden people move very quickly. They figure out how to, raise capital, bring on new partners, type of stuff. Fear. When I was at YouTube, I was heavily recruited by VC firms because it was around the era that they knew that they couldn't just have bankers and lawyers. They needed operators. So we have to hire people from Facebook very fast. Every other transformation of venture, you need to think about, are your hiring practices, are you truly getting the best people in there? Or are you just, replicating, the same resumes as before? Forget even the ethical value or moral reason for doing that. Are you looking for the best talent to get the best returns, right? There have been periods where the industry has picked up its head and said, we should really question our practices. And then they go right back to sleep because they're not fearful or greedy enough to capitalize on it. And so Screendoor is going to capitalize on that, right? Screendoor finds these emerging managers whose lived experiences, give them a real different perspective into venture than the average, Hunter Walk, being 12 years into venture and with my own life experiences, and then helps to put them in business, right? The way I was reading, Andrew Chen from Andreessen sent out his it's been 6 years at Andreessen this morning, and he noted that when he joined Andreessen, there were 100 people, and now there's 600 people, right? Incredible growth, right? That's a company. That's a big company. So Homebrew started as 2 people, peaked at 5 when we had a principal for a few years. Now we're 4. Homebrew never wants to be 600 people, but Homebrew wants to punch above its weight as if it was 600 people, right? I mean, Satya and I want to make the impact. And so how do you do that? Well, add up all the teams in the Screendoor portfolio. And I think over time, in aggregate, that will be a group that transforms venture. It just won't be with me sitting at the top of the pile, with my name on the wall or collecting disproportionate economics or whatever. And I'm not pointing fingers at anybody. I'm just saying that was a non-goal for us. But the idea of building something that matters and impacting our industry was a goal. So we had to find a different way to go and do it. We also don't, I think there's a lot of firms and individuals who invest in new managers, and they use them as scouts. They use them as minor leagues.
Yeah, I was going to ask about that. So because you have access to these new managers, are you using them as scouts? Do you use their deal flow, keep it bifurcated?
Keep it bifurcated, right? So Homebrew, Satya and I are individual investors in Screendoor, as are the other sort of VCs who help get it started. We are a minority of the capital. The majority of the capital comes from large endowments, foundations, so on and so forth. We don't collect a salary from it, anything like that. So my only upside is in the fund performing. I'm doing it because I care a lot about it and I think it's fun. And the annual reports, the quarterly, they go to Screendoor. They go to the team of three who use it for their own underwriting and investment decisions and reporting. I don't have, structural access to that. We're not processing that data to fill up our CRM, so on and so forth. Is there collaboration, opportunities amongst the portfolio and a Homebrew, the portfolio and a Forerunner, the portfolio and a Precursor? Obviously, and I hope they are. I think at the beginning, I probably sent more deal flow their way than they sent to me. But like over time, that should change. But I think of that more as like like-minded investors collaborating to the benefit of founders, rather than, hey, the cost of taking our money is you have to syndicate with us type of thing. I would never look to do that, because ultimately I'm trying to fund competitors. I'm trying to fund people who are going to be equal or better investors than we are. I'm not trying to fund the minor leagues. I'm not trying to gain a foothold in the next generation to make myself relevant. Like, I want to build people who, much like when we said earlier, you invest in founders as a VC firm, you invest in founders who you don't think need your help to succeed, but whom you hope your help will increase the chances of success. Same thing with Screendoor. I'm investing in emerging managers who I don't believe need our help to succeed, but we believe that our participation and our particular point of view on what we can provide them compared to other LPs will give them access to more information, more relationships that increase the likelihood they will build a successful firm.
Because you've gotten access and exposure to managers that are fundraising as well as founders, right? But on the manager standpoint, as the market started to swell for venture capital, and then all of a sudden everybody is a venture capitalist and wants to be a venture capitalist, how has that made the screening process for Screendoor evolve? And like, what kind of trends have you reduced from those initial conversations or the processes in which you use to filter out fund managers or theses, or like what makes a real enduring manager versus someone who just wants to jump in and go for the ride and see how fun it is?
I think last year we got over 700 applications. So we see a pretty good cross-section of new emerging managers. There's some things that filter out just based on sort of, the size that we are and sort of trying to make sure that we're doing a good job in our earliest years. For example, we'll look at North American and Latin American, South American funds, but we don't look at global funds, right? So it's not because we've made a decision that, emerging managers in Europe aren't as good as the US or anything like that. It's just, we can't do everything at once. So, something is just like, are you in the box? Are you in the box that we are prepared to underwrite? In terms of then of what we look for, it's so much better now that we have this team of three who actually did this for a living before, because they have real systems. And like, I don't think we were making bad decisions before, but I think our process wasn't as good and quick as we wanted to be. We're never going to be, we're never going to be 48 hours to a term sheet like, maybe a VC will be, but we're also not going to be 9 months to a no, right? Like, and so we're trying to add a level of deliberateness, transparency, and feedback to the venture process as a GP that I think not all of us experienced when we were fundraising. And so I think they look for some of the things you were pointing out, like, are you raising a fund or are you building a firm? Obviously, you can't put cart before a horse, but we're interested in people who have some idea of like what fund one is meant to do to get them to fund three, to fund two to fund three, and more so than just like, oh, I worked at Brex. There's a bunch of people spinning out of Brex to start companies. I'm going to invest in Brex alumni. I need $10 million to do that. Now, that person could be incredibly successful, at least for a phase. All those points are true. But if they're not necessarily thinking about what does that give them the ability to do, what does it mean to be to invest other people's money? Is this something they want to do full time? All that type of stuff. it might be a great investment, but it's probably not a Screendoor investment.
Mm-hmm.
If I had to sort of say qualitatively, what's one thing that I see pretty binary in the way that Screendoor makes decisions, I'd say that there usually has to be a why, and that the why should make sense, should be consistent and make sense to both LPs and founders.
Okay.
So if you can't answer, why are you doing this and why does this fund need to exist? I would say, like, please think that, not because I'm like, it wastes my time, but because I think if you don't know that, if you don't start knowing that, it's going to be harder for you to articulate to the people you need to work with about, why you should be included in a cap table or why an LP should give you their money. So why does this fund exist? And then to the extent that the answers you would tell a founder are different than what you'd tell an LP, I think at best it's confusing and at worst it's duplicitous, right? Like you're sort of, somebody's the rube, right? And I think the firms that we've backed, Voyager in the climate space, Ex Ante out of New York, focused on what Zoe calls agentic technology at the intersection of AI, security, defense, a bunch of stuff. Slothin, Maple, a bunch, don't mean to leave anybody off. I'd say are all able to answer that question specifically. And we believe that their answer resonates with both founders and investors besides ourselves. So that's how I would describe it. We try to back fund zeros, fund ones, maybe fund twos, depending upon, what those look like. We try to be an anchor, we sit on some LPACs, that type of stuff. And, we want you to build a successful firm and then, hope to be able to continue and maintain our support in the ones that do so, right? So we want to be an enduring, best of class fund of funds. I say we are an economic vehicle with a societal strategy. So we're not venture DEI, we're not venture reparations. We believe that looking at the type of people who are being pulled to venture now and starting their own firms, that there's an incredible set of people, like I said, with identities, networks, and lived experiences that when they inform their investment and firm building strategy can be incredibly powerful, will certainly outperform the mediocre large investors and have a chance to be the next generation of franchises.
Yeah. I actually was on the fund to fund side for a little bit when I was at Corporate Venture Fund, New York Light Ventures. And so I saw that kind of impact of the first funds that we invested in and seeing the first time managers and their outperformance. I don't know what the science is behind this, but it's a real thing. The first fund one, fund twos really outperform. I don't know if it's because of the size, because of the initial access. But it's a tremendous point in time to get kind of like exposure into and then also have like ownership in. But I'm curious. So in this current market, there are thousands of funds and new managers going out to raise. Between the fund ones to the fund threes, those are the incremental, like very, very important years to get the fund fundraised. And there are certain metrics that people go by. There's some sort of signals that people go by. What have you seen, especially from your exposure with Screendoor, of like what should the typical kind of fundraise process look like, or what kind of boundaries should you put if it's like a time frame to go out and see if you can raise during that time frame, or B, the types of investors you get in at each kind of stage of that fund cycle, and then C, in terms of like the longevity of the fund and in exposing that to like building out further, do you have any sorts of advice you give to them? But I'd love to just kind of get your understanding between your experience from Screendoor, like how should these new managers go out to raise, and at what point should they should step on the gas or step on the brakes?
This is gonna be we might have to do a whole part two. So I believe, I think you're right to sort of separate, like fund one gets raised on potential, fund two gets raised on momentum, and fund three gets raised on results. In terms of how you raise and how much you raise, I think fund one should be your minimum viable fund. You should time box how long it takes to get there. Your minimum viable target might be your, truly minimum viable target, it might be less than your soft, cap, and certainly less than your hard cap. I think one mistake that emerging managers make is, the first half gets raised easily and then the second half takes forever and they fundraise for an extra 18 months. Like, I think at some point you underestimate the cost, mental exhaustion, so on and so forth, and trying to fundraise and fund deploy at the same time. Much better to get to your minimum viable fund size, set a final date, herd all the cats you can, and then just get out there and investing. Because what you're trying to prove with that first fund is really one, that you're kind of quote unquote doing what you said you do. But what that really means is access and picking. Sure, it's amazing if you can perfectly manage, ownership and so on and so forth, but you just got to sort of stay within your weight class. If you're telling people you're going to lead rounds and you're not leading any rounds, you're not doing what you said you do. But if you said, "Oh, I'm going to target between 3 to 5% ownership," and you target 3.1, or you actually get 3.1 on average, or you didn't raise enough to do follow-ons. Like, if you're a great picker, you'll still be fine, and you can always, going into a second fundraise, you can always say, "Look at these great companies I got into. Because my fund was 20 million, not 50 million, I had to take more dilution as opposed to following on. More money will allow me to write slightly bigger checks and hold ownership longer." People believe that. They won't believe more money will make you a better picker. Like, because I had a $20 million fund, I didn't invest in any good companies, but give me a $50 million fund and I'll invest in good companies, right? So for me, fund one is like your minimum viable proof of concept fund. Figure out what that is, raise it, and deploy it. Then when you sort of have the momentum that says, I am doing what I said I would do, I have de-risked this notion of I can pick a good set of companies, I can get close to my target ownership, and I can be a little bit opportunistic here and there. And by the way, my founders and co-investors will all say very nice things about me. You might not have, in 2018, you probably would have had, a bunch of markups, so on and so forth. Now, sometimes you'll have some markups, but you'll have a bunch of stories to tell about the companies that are working, and, some, ones that aren't, whatever. But like, you'll start to see multiple pathways to a good fund. That's when you go and raise fund two. Fund two shouldn't change too much. Like, if you're adding, sometimes I see people try to add a partner, move up a weight class in terms of like, as opposed to 1 to 3%. Now I'm gonna lead rounds, or they try to change too much at once, including fund size, and that will sort of say like, whoa, hold on, like, change one thing, right? And ask people to bet on that succession. By fund three, you're sort of trying to show that, like, you're trying to sell into LPs who are jealous they didn't get into your fund one and two, right? Like, they're the people who be like, "Oh, I want to just build a relationship and wait for results." And you should be able to say, like, here are the results. They may not all be on paper, it may be TVPI versus DPI and stuff, but it should be real, right? And in terms of who's writing you those checks, like, the reality is, anybody you want to be in business with, right? Like, we were fortunate enough, we had a small number of institutional LPs. We decided to take that concentration risk. That's not available to everybody. I tell everyone that different types of LPs have different types of risk profiles. High net worth individuals are going to come and go based upon where their stock is in the company that made them rich, or blah, blah, blah. CVCs are going to come and go based upon whether they have a CVC program. There's a big wave of like diversity checks from Twitter and JP Morgan, and like, those things come and go. So I think you want to look at your LP base as the largest percentage of people who, if you do what you say you're going to do, will re-up, and who you are proud to be in business with. So the folks who want preferential treatment, or are investing in you for some reason other than your returns, strategic, they want access, they want ownership in your management company, they want you to commit to giving them first look at your pro ratas. You don't do your pro ratas, I do your, like, all of those things. I know there's managers who take those dollars because they're like, look, that's all that's available to me. Like, champagne problems, like, I'll do what I can and then I'll solve that problem later. I totally respect that. But I think if you sort of at least say, the two things are, if I perform the way I say I perform, are these people likely to invest in my next fund? And do I have any hesitancy about being in business with them? And if the answer is if that's yes, they'll re-up, and no, I have no problems, take money from them. And then over time, you're going to want to build out a base of people who, are willing to commit 5, 10, 15, maybe even 20% of your fund. And that'll give you, fewer people to manage, fewer relationships. I'm a believer in concentration risk, right? So like we went from 4 LPs in our first one that made up like 90% to 8 in the second one that made up about like 97%. Like, and if they all talk, right? Like, so if all of a sudden like we're not doing well and they're like, well, what are you doing about Homebrew? You're re-upping, blah, 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 blah. I mean, they all make independent decisions, but like, no group think, but certainly like, and so some people like to keep those pockets separate, like, oh, you really shouldn't take too many endowments because they all think as a group or whatever. And like, it's true, but not true, And we're always like, look, I want people who are professional investors because they understand the market. So when we say, hey, here's what we're seeing in seed, if it's true, they know it. And if they have access to different parts of the market than we do, so we can say, what are you seeing in growth, right? And we can hear that. Who are only in business with us for our returns. Obviously, they want us to behave in moral and ethical ways and not embarrass their institution, stuff like that. That was, we're fine with that. Like, best things my investors have ever said is like, we sleep well at night knowing like we're unlikely to ever wake up in the morning and see a headline with you guys, in it for something that we don't want to be associated with. And they're enduring, they have an enduring commitment to the class. If we underperform, they'll drop us. And if we hit our target / outperform, they'll continue with us. That's all I've ever wanted. Like, judge me on my outcomes, my success, and that, did I do it in a way that feels good to be associated with, right? Mm-hmm. Everything else, was sort of a distraction. And we were lucky enough from early on to be able to say no to some people where we thought that those criteria, were misaligned.
Yeah. Look, I could probably ask you 40 more questions, Hunter, but I know we're running over time, and maybe this does call for a part 2. But to kind of close out and put a bow on all of this, what advice would you have for emerging managers in this current cycle? I mean, I was just, around Milken, everyone's fundraising, they're trying to go out. And it's kind of a hard market to do it. Most portfolios have taken a slash. And there's lots of investors fundraising. So what kind of advice do you have for these newer emerging managers that are looking to like beat down the doors and become the next generation?
Yeah. Well, I mean, besides all the stuff we talked about, which is like, what do I think the components of a successful firm are? If you're somebody who's in motion, and you're deploying and you're trying to sort of prepare for your, next fundraise or your first institutional fundraise or so on and so forth, I guess the 2 pieces of advice that I have, one would be like, be really self-aware and like confident, but also honest, right? So I sometimes see decks where the individual, I feel like, is casting their previous experiences in a way that is favorable, but doesn't stand up to reference check, doesn't stand up to reality. They're marketing themselves as opposed to talking about their history of investing, of operating, so on and so forth, in a way that says, here is the sum total of what I've learned and accomplished, and here's why I'm going to be a great manager. The best investors make investments that turned out to be horrible, right? And if you just say, if you don't talk about those or you don't learn from those, then I don't know why the probability of the investments you make next year are going to be any better. It's sort of it's the way, you talk about sort of the football, the quarterback throws an interception, but then when you look at the film, you can decide whether that's a pass that he should always throw, because 90 out of 100 times it'll be a touchdown. 10 times out of 100 it'll be an interception. That's a risk worth taking, especially in a power law, business. Use the venture metaphor. One of those touchdowns would be worth, 1 billion points, right? Or is that a tendency to break? God damn it, we told you to stop throwing into coverage like that. You can't, it's only 1 out of 100 times is that going to be successful. If you keep doing that, you are not going to be a starting quarterback, right? And I think I'm most impressed by folks who, look, it's been a hard market the last few years. Some things have up, some things are down. People who are able to project, confidence, but also learning, introspection, in lieu of being able to always talk about all the write-ups, talk to me about the ones that you helped wind down and why like being proactive, recovering some of that capital and being able to redeploy it gives you the best shot at turning that, dollar that became a quarter, turning it back into a dollar, as opposed to
Right.
just, well, I don't want to talk about it because the founders broke up. Or like, show me how to think about yourself as a professional investor, not just a, you know, um, a byproduct of hot markets and FOMO and all that stuff. So like, you know, that's what I would say. Like, um, take me on a narrative journey through the work you've done, which includes all the wonderful stuff, but also tells me what you've learned from, the unknown or less successful parts of this. And don't try to change too much too quickly. It's perfectly fine for your fund two to be your same size as fund one, to be whatever. If you had raised a fund one in 2020, let's say, and you said, I'm going to get 5 to 10% ownership, and I think I need to write a $3 million check to do that. And the reality is that there's been a little bit of a market correction to now where you can get that same ownership for $2 million. Like, it might actually make sense for your fund to be a little bit smaller, right? Like, don't use AUM or increasing AUM as a measuring size for your success, for your momentum, for anything. Obviously, especially for emerging managers, there's real implications for that in terms of you got to pay your bills, and so your minimum viable fund size has to pay yourself a salary. It has to pay, all these costs of running a fund. So I'm not saying like, do the equivalent of bootstrapping a VC, but like, don't, um, don't design your product based upon, what other people tell you should be. Like, know who you are, design the product around it, and portray it accurately. That's my. And then I'd say there's a whole bunch of things around fundraising where we don't take our own advice. We tell founders how to work with VCs and like qualify up front whether you're going to spend time and this and that, but yet we end up sort of on all these long journeys with investors who are never going to commit to us. And so I'm a big believer in a whole bunch of processes around, throughput, and then you decide who you want to spend time with and how to follow up with people, how to set closing dates, all that type of stuff that force people down that pipeline or not. And you can talk about that separately. But I'd say, all of that is secondary to, the product you're actually bringing to market.
That's great advice. That's like very honest. It's thoughtful, and of course, you're just a very well-informed person, having the dearth of experience and exposure you have. Not only
Nice way to say a bunch of gray hairs.
Look, you can get gray hairs when you're 20. You could be 14 for all we know. But like truly, like it was a pleasure having you on, Hunter. I really appreciate you coming on and sharing your expertise. And I will
Sure.
hold you to the second episode that we will do as a follow-on to this later on. But thank you so much for coming on. It was very insightful.
No, thanks for having me. I really enjoy your newsletter. I enjoy you, and I appreciate the chance to reach some new people. And I try to return every email at least once. So cold email is fine.
Great. Thank you, Hunter.
Sure.